So today's cardinal lesson, we're talking about IRMAA again. And so we're going to be talking about appeals. And so what is IRMAA? IRMAA is income related monthly adjustment amount. It's like a code name made up by the Medicare people. It's a tax on the well-to-do retirees. So it's a Medicare tax. And it's additional money that you pay through your Part B premium and your Part D premium. And it's something that most retirees, when they are just getting ready to retire or just going on Medicare, this comes as a real surprise to them, that they're not too happy about. So today we're going to be talking about, can you do anything about it? Can you appeal IRMAA? Is there a way to make your IRMAA go away or certainly get reduced? And the answer to that, of course, is yes. So before we get into that, we're going to just do a little review of what IRMAA is it starts for a single person at $103,000 of taxable income. And that's taxable income, and then it has this thing called MAGI, or modified adjusted gross income, MAGI, and it's going to be added in any tax-free interest or tax-free bonds that you own, are going to be added onto your income. So the threshold for a single person is 103,000, and that's in 2024. And the threshold for a couple is 206,000. So if you go on Medicare in 2024, like you're just turning 65 and you're just going on Medicare for the first time, they're going to use your 2022 tax return. So they're going to go back and take 2022, and they're going to send you this nice little letter if you married, filed jointly, and you were over 206,000, telling you that your Part B is going to be more than the $175 a month or thereabouts. If you made more as a single person in 2022, a single filer, 103,000, you're going to get surcharged and you're going to be paying this IRMAA tax. So that's just and it can be as much as $6,000 a year for one person. In a couple, that's $12,000 a year extra that you pay on top for your Medicare. So I want to bring Tom on, and I want Tom to share, why are we doing this video today? What's the purpose of talking about IRMAA appeals?
Yeah, I mean, we're doing this video because of all the things that anger the people most about Medicare. It's this IRMAA. It's they don't expect it to come. They somewhat maybe excited about Medicare, and then they get this letter saying now you got to pay whatever the amount is more than they were expecting, and they can get really upset. And so what we want to do, and to add on that, is a lot of times they might get the letter and they'll try to file this appeal by themselves and they get turned down. So now they're even further upset. And so what we want to walk you through today is how to properly fill out this form, to send it in, walk you through some of the examples of people who have made some mistakes and where there's common mistakes we see when filling this out, trying to give you some advice on how to do this. Ultimately, though, and we'll get to this at the end, is you really need to work with somebody who is familiar with this form, who's filed a lot of the appeals, so we can help you with the appeal process. And so let me bring up the show notes. We can find these at the link below in our video. They're also on our website at cardinalguide.com. As always, we have the board. You can see a little bit more in detail, but I want to spend some time today really looking at the form that you use to file the appeal. And I will point out, like Hans had mentioned, the income they're using to determine your Medicare cost is always from the 2 years prior. And that's on a rolling basis. It's a question I often get. It's like, okay, I'm retiring now in 2024. They're using the 2022 income. When I get to 2025, will they look at 2023? It's always 2 years, the 2 years prior. So it's on this rolling basis. They reevaluate this annually. And so sometimes, and we'll get into the form here in a second, sometimes there isn't a thing that we can appeal. It is what it is. You have to pay it. But if we can do some things to look forward in the future, maybe we could further reduce your IRMAA in the future. So let's get into the form here. Again, this chart, we have other videos that talk about this, but this chart really has to do with just the different levels of IRMAA. There are sort of different brackets. I will point out, it's not like our tax rates where you sort of get to fill up the lower brackets. Is if you go $1 above that threshold, you're in that bracket. You're paying that increased IRMAA cost. And so it's a cliff from that standpoint. Is as soon as you get into that next bracket, even $1 into it, you're paying that IRMAA cost for the next year, or for that year you're in. I do want to point out one other thing, and this is something I've run into often, is for whatever reason, we'll have a couple that comes in and they've decided that they want to file their taxes married filing separately. And they've run through all the numbers, and everyone's situation is different. There aren't oftentimes that I actually see it makes sense to do this, but if you're doing it, I want you to be aware of what happens with IRMAA. Is if you look at the married filing jointly charts here, the first threshold is 206, and then it goes up from there. But in the married filing separately, it's this box down at the bottom. If you go to the 103, which is the single rates, which that's kind of makes sense, you're filing single, is your IRMA though goes up to 384, as opposed, which is like the second highest level it can be, right at the 103 level. So tread carefully if you're filing taxes separately. I just want to point that out. But what the video's on is how do we file the appeal, and that's really where we're going to spend most of the time on this form. At this is, I think, this is the second page of the form. If you look at it, it's really not that complicated of a form, but I will point out some of the things that people make mistakes on. So if we just go piece by piece, the first step to this appeal is you need to have a life-changing event. That's step one. If you come in with IRMAA, all the questions I'm going to ask you are around trying to identify, is there a life-changing event that we can put on this form? We have it on the board, but again, I'll just read them off real quickly. Marriage, divorce, death of a spouse, work stoppage, work reduction, loss of income producing property. I'm going to come back to that one because that's often confused. Loss of pension income or employer settlement payment. And so people look at that, and those are the life-changing events. If you try to file this appeal and you don't have one of those life-changing events, pretty good chance it's going to get turned down. Or maybe you have a life-changing event that you're not pointing to in the appeal, it's going to get turned down. And so the ones we use most often are work stoppage and work reduction around retirement, or slowing back your work. That's what we by far mostly use on these appeal forms. Sometimes we'll run into someone who's maybe just got married, which we will use, or if there's been a death of a spouse, we'll sometimes use that. But Hans will make a joke, and I agree. You know, death is not a good planning strategy, so don't plan on using that one as the life changing event there. Um, there needs to be a life changing event, and then the second step of this appeal, there needs to be a reduction in income. And so those don't always have to be tied together, because really the person processing this form, all they're looking at is your tax return, those two lines, the adjusted gross income and your tax exempt interest. They add it together. Is it higher than the IRMAA thresholds? If yes, you're paying IRMAA. If not, you're not. And so when you're filing the appeal, you don't need to get into this long explanation. And this is the thing I see people make the most mistakes in, is they write this long sort of essay, if you will, explaining why they shouldn't have to pay this, and they don't address the life-changing event or the reduction in income, and they get turned down, and they don't understand why they've got turned down. And so you really need to, if you're going to send in a cover letter, which sometimes I would recommend, keep it short, keep it to the point. I had this life-changing event, my income is now less, I shouldn't have to pay this. That's really all you need to put on there. And again, we help people with this all the time. Uh, Again, one of the things that I will point out is you are projecting your income in the future. So if you're filing this appeal in 2024, you'll put your projected income for 2024 and then for 2025 if you just read through the form. And so you need to have some basis for that projection. You don't want to just make up a number, because they will come back and recoup if you way underestimate your income. But it's a way, you can do some planning around that. It's like, as an example, let's say, so we knew someone was retiring at the end of 2023, just as an example, and we're looking at doing a Roth conversion for them. We might intentionally do that in the year, really blow past these IRMAA thresholds in the year of 2023, knowing that they won't catch that from an IRMAA standpoint until 2025. 2024, they'll have been fully retired, and we can use that as an appeal to reduce their Medicare premium. So that's just one example of a way that we can strategically know how this works, how the appeal works, and do some planning in the short term to plan for the future. So I don't want to get rambling too long. So Hans, any comments on that?
Well, just doing these for a lot of people, this is the number one, is work stoppage. I mean, we have a lot of people come to us when they're going on Medicare, turning 65. They were still working in 2022. And so that's when they had the high income. and then maybe they sold their house and was over the exemptions, or they got some stock options that they revealed, or they sold some land or sold some property. They had a big spike in income, but it's the work stoppage that drives the whole thing. Is they retired, maybe just retired, or they're going to retire in a month or two, and that's the number one reason. The second one that is most used is work reduction. Is with a lot of professionals, uh, that's what they do, is they start working less, but they're still working. And then if we can document all of that and get their income, perhaps we can lower IRMAA. So it's really those two that people have control over. And it's kind of a natural thing that happens when you're going on Medicare. So, and then I'd also just point out, they need a date that this life event happens. So if it's, you're using work stoppage, they need a letter from your employer or something that indicates that you retired on, May 10th of 2024 or May 1st or whatever. They need a letter to that effect. And then if you can't obtain that, then there's a way for you to document something. We can help you with all that, but just as Tom pointed out, people that do these on their own, generally, then they bring them to us, and it's real clear with us, what we need to do to fix it. So if you want help with this, we're more than happy. We're in all 50 states in the District of Columbia.
I want to speak to one of the life-changing events on this form that I often see misused, and it's the loss of income producing property. So what a lot of people might have is they might have a rental property or other property they've been renting out and they choose to sell it, which is totally fine. There's reasons to do that. They sell it, they incur capital gains, it spikes up their income in any given year, and now it's less. And so that's a very common thing that we see happen. And so they'll look at this form and they'll say, oh, I had a loss of income producing property. I'll check that box, explain it away. I sold my property and hope for the appeal. And that's going to get turned down every single time. And if you, I'll bring back up the show notes because I want to, I'll just read this to you guys. And it's right there in the forum on some of the later is it talks about what is these life-changing events, actually describing them. Loss of income producing property. You or your spouse experience a loss of income producing property that was not at your direction. So it talks more about what it includes. Not at your direction. If you sell a property, you have chosen to do that. That does not qualify as a life event under that particular one. And so don't try to use the loss of income producing property when you've sold a property and raised your income, because it's not going to work. And so really they're talking about things that are, affected by like natural disasters. If there was arson, if there was theft, like someone's, I don't know how you'd steal a property, but if you stole it somehow, I mean, those are the type of things they're looking at, but it's not the sale of a property. And so there are other ways we can use some of the other life changing events around someone selling property around like work stoppage or work reduction. So if you're in that situation, let us know. We can maybe help you out, but do not use a loss of income producing property when you've sold a property. That's not going to work. So I just want to warn you because that's a common mistake I see often made.
Okay. So, Tom, I'd like you in the show notes to bring up that last chart, because that really, the best part about that chart, it's a summary from a program that we work with on tax planning. And I really want to show that a lot of the planning points that I'm going to go over are on that chart. And there's just, so what we're going to do in the last part of this thing is we're going to talk about when we look at a person's retirement. A lot of people that come to us just going on Medicare, maybe they've been on it for a few years, or it's a couple of years from now. So we're looking at IRMAA, but then we're also thinking about, okay, so what can we do over the whole of their retirement to have some effect on IRMAA? And I got to tell you, if you make a lot of money and you've got a high income because you have a lot of money and you have a lot of investments, there really isn't much you can do about IRMAA. I mean, that's the bad news. The good news is you got a lot of money and you got a lot of income, and the government's just going to make you pay for your own Medicare. And I know you probably don't like hearing that, but if you're a person that has a good amount of wealth, but you're not way up there where you're not in control of your income, then there's some things from a tax planning perspective and an income planning perspective that we can do that's going to affect IRMAA over the long term. One of those is Roth conversions. before Medicare. I mean, if before you go on Medicare, if we can catch you in your early 60s or catch you still working and delaying Medicare, then we may want to think about doing some Roth conversions now, which is going to drive up your income and make you pay more IRMAA. But then if we can appeal the IRMAA when you ultimately retire, because you're going to have a lower income. So Roth conversions are bad for Medicare IRMAA in the short term. In the long term, they're wonderful because if we draw income out of that, it doesn't count as your income. It's not taxable. IRMAA is not the only thing under consideration. So when we have people that have accumulated wealth and we're planning out their retirement income and then we're planning out their estate and taxes, and they want to keep a lot of that intact and then pass it on to their children, or they want to prepare for older age, that kind of thing. People that get angry about IRMAA sometimes put all ships are set on IRMAA in preventing it, and that's a mistake. I mean, IRMAA is going to be for 1 year or 2 years or 3 years because of a spike in income. Is a Roth conversion, which may cause IRMAA, or several Roth conversions over a number of years, are going to have tax benefits for a whole lifetime. And even beyond your lifetime, when you pass Roth money on to your children, they're not going to have to pay income taxes on the required distributions. We're going to talk about the RMD effect. So we always are going to sit down with people in their 60s and talk about required minimum distributions that start at 73, 74, 75. And so there can be people that are under IRMAA because they choose to live that way, but they have a big, huge IRA, maybe on both of them, and they just choose not to take anything out of there until they're 73. Then all of a sudden, that big RMD comes in and starts at 73, and that drives them into an expensive IRMAA. So we may want to use some time between 65 and 73 to address that so that we won't have such a big spike in IRMAA and Social Security taxes. So, and then talking about qualified charitable distributions. So, at 70 and a half, you can give part of your IRA up to a little over $100,000 a year per person. You can actually donate to a charity. Now, there's not tax reasons enough to give $100,000 away or $10,000 or to give part of your IRA away to a charity. There's got to be charitable reasons. You need to be charitably inclined. So I'm not sitting here trying to tell you a smart tax strategy is just giving your money away to charity or giving your IRA money. What I'm saying is if you're charitably inclined and you're going to give the charity money, either at your death or year by year by year by year, start giving them money out of your IRA after 70 and a half, so much a year, and that will not count in your income numbers. You won't pay any tax on that money, neither will the charity. And it's a good IRMAA strategy or part of an IRMAA strategy. So now I want to go over what have we talked about today in terms of the 7 worries and the financial planning that we do. We talked a little bit about Social Security. We talked about Medicare. We've talked about your 401k and IRA. We've certainly talked about your income because it's your income number that drives IRMAA. We talked about estate planning, and we certainly talked about taxes because in a way IRMAA is a surtax. So I'd like to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening to us.
Thank you.